The cost of debt represents the effective rate a company pays to its lenders or bondholders for borrowed funds. Since interest expenses are tax-deductible, the post-tax cost of debt is typically lower than the nominal interest rate, making debt an attractive financing option. The cost of debt plays a vital role in determining the weighted average cost of capital, WACC, and evaluating the trade-off between debt and equity financing. It provides insight into financial leverage efficiency and solvency. Sources of debt include bank loans, corporate bonds, debentures, and convertible instruments. The measurement of cost of debt depends on the instrument's nature: fixed rate, floating rate, redeemable, or irredeemable, and the method of repayment or conversion. For bank borrowings, the post-tax cost of debt is calculated as KD, where I is the nominal interest rate and T the corporate income tax rate. This reflects the tax shield benefit since interest payments reduce taxable profits. For example, a 10% bank loan in a 25% tax environment yields a post-tax cost of debt of 7.5%. This approach assumes that the loan is held at par value and interest payments are consistent. While simple, it is widely used for term loans, overdrafts, and other bank facilities. The key factors influencing the rate include creditworthiness, collateral, maturity, and market interest conditions. Prudent treasury management ensures matching of borrowing terms to asset life, avoiding liquidity pressure from short-term refinancing of long-term assets. When debt instruments such as bonds or debentures are traded in secondary markets, the relevant measure becomes the yield to maturity, YTM, the internal rate of return that equates the present value of all future interest and redemption payments with a bond's current market price. Mathematically, YTM is derived from solving P, where I is annual coupon interest, R is redemption value, and R the yield. Once the pre-tax YTM is determined, the post-tax cost of debt is KD. For irredeemable debt, the formula simplifies to KD. This method captures both coupon payments and capital gains or losses on redemption, reflecting market expectations of interest rate movements and issuer credit risk. Convertible debt introduces additional complexity because investors may opt to convert bonds into equity rather than receive repayment in cash. To calculate the post-tax cost of convertible bonds, both redemption and conversion values are assessed, and the higher value is used in YTM calculations. For example, if a $100 bond is convertible into 10 shares expected to trade at $12 in 5 years, the conversion value, $120, exceeds cash redemption, guiding valuation. The post-tax cost is then adjusted for the tax deductibility of interest during the bond's life, even though conversion eliminates repayment obligation. Convertible bonds thus lower initial financing costs while offering investors equity upside, an appealing hybrid structure for companies seeking flexible long-term capital. Issuance costs and market discounts also influence effective cost of debt. Bonds issued below par have a higher yield since redemption exceeds initial proceeds, while those issued at a premium result in lower yields. Accounting standards such as IFRS 9 require amortized cost measurement using the effective interest rate method, ensuring that interest expense reflects the true cost over time. The finance function must periodically reassess borrowing costs in light of refinancing opportunities, credit rating changes, and interest rate movements. Misjudging cost of debt can distort investment appraisals, leading to acceptance of projects that fail to meet true financing costs. Ultimately, the cost of debt must balance affordability, risk, and strategic objectives. While debt enhances returns through leverage, excessive reliance increases vulnerability to cash flow fluctuations and covenant breaches. A sound capital structure maintains moderate gearing, ensuring interest obligations are comfortably covered by operating profits. Regular monitoring of interest coverage ratios, yield spreads, and refinancing terms safeguard solvency. Accurately computing post-tax debt cost is fundamental not only for valuation and budgeting but also for preserving stakeholder confidence in the company's financial prudence and sustainability.